You are currently holding an asset worth $543,000. Not in a brokerage account, not in real estate. It's inside you. And right now, today, it is depreciating faster than any currency on Earth. Most people spend their lives searching for the right investment, the right stock, the right property, the right moment. They are looking in entirely the wrong place. Before we go further, if the idea that your own potential is your most valuable financial instrument is new to you, you belong here. Drop your core investment philosophy in the comments. This channel exists for people who take that question seriously, and your thinking strengthens everyone in this community. Every person possesses a stream of future earnings. That stream has a precise, calculable value in today's dollars. Economists call it human capital. Finance calls it net present value. You should call it your most important asset. The formula is not complicated.
Take every dollar you expect to earn in your working life. Discount each year's income back to the present at a real rate of 3%. That is, 3% above inflation. Sum those figures. The result is the true financial value of your career, expressed in today's money. Now, run that calculation for two people. Same age, same starting salary of $1,200 a month, same 25-year horizon. One invests in skills, one does not. The numbers that come out of this model should make you uncomfortable. The person who stays still, no new skills, no deliberate development, the same $1,200 every month for 25 years, accumulates a human capital value of $250,749. That is what a stagnant career is worth, in today's dollars, over a full quarter century. The person who invests in themselves follows a different curve.
From year 7 onward, $4,500 a month, held all the way to the end of the 25-year window. The NPV of that second career path? $744,355. Same discount rate, same time horizon, same starting point. A difference of $543,605, generated entirely by the decision to learn. Read that number again. $543,605. That is not a projection built on optimism. It is arithmetic, run at a conservative real discount rate, using income figures that are modest by any professional standard. It is the financial cost of standing still. They feel poor in their 20s because they are looking at the wrong column on the ledger. The financial capital column is nearly empty, but the human capital column, the NPV of every future dollar they could earn, is at the highest point it will ever reach. Warren Buffett has said it plainly. Skills are the best inflation-proof investment a person can make. They cannot be taxed at the point of formation. They cannot be confiscated by a government. No macro shock, no recession, no currency crisis, no systemic collapse can reach inside your mind and remove what you have learned. Think carefully about what that means. Every other asset you will ever own exists outside of you. It can be taken, it can be devalued, it can be rendered worthless by forces you do not control. But knowledge, once acquired through disciplined effort, is permanently yours.
When you invest in stocks or bonds, there is always a counterparty, a company, a government, an institution that must deliver on a promise. If they fail, you lose. Your knowledge has no counterparty. There is no institution that can default on what you already know. When you earn a return on financial capital, the government taxes that gain. But when you invest in your own mind, No tax authority can assess what you have not yet earned. And unlike any financial instrument, this asset cannot go to zero. The knowledge already exists inside you. It cannot be recalled. So why isn't everyone compounding this asset aggressively? The answer is not intelligence. It is not access. The answer is where the hours go. The average person spends 2 hours and 31 minutes on social media every single day. In the United States, total daily.
These are a second job, paid in distraction, not dollars. Every hour redirected away from skill building is an hour not compounding the $543,000 asset. The opportunity cost is not abstract. It is measurable. It is the gap between $250,749 and $794,355, allocated in minutes, day after day. At the office level, social media pulls the average worker away from productive tasks for 1 hour and 15 minutes every single day. That loss cuts total output by 12%. Globally, distraction costs the world economy $438 billion in forfeited production each year. That figure, $438 billion, is not a moral argument. It is the market's precise measurement of what passive consumption costs in aggregate. Multiply the logic down to the individual, and the personal cost is the $543,605.
The mechanism is simply time. Time directed toward consumption instead of accumulation, compounding in the wrong direction, silently, every single day. The years in your 20s and 30s do not come back. Unlike a stock, they cannot recover. Unlike a bond, there is no maturity date that returns your principal. The peak window of human capital is finite, and it is moving. But here is what nobody tells you about protecting it. The threat is not just time slipping away. It is every dollar you hold in the wrong asset, quietly being destroyed by a force older and more ruthless than any market correction. That force has a name, and every traditional investor.
What it does contain is the arithmetic that most financial conversations quietly avoid. When prices rise faster than your savings earn, your purchasing power shrinks. The dollar in your pocket today buys less tomorrow. That is not a risk. That is a certainty. Warren Buffett has studied inflation longer than most people have been alive. His verdict on cash and fixed income bonds during inflationary periods is not cautious. It is absolute. He calls them the worst assets you can hold. Think about what a bond actually is. You lend your money to a... Buffett once described every ounce of gold ever mined in human history. Melted down, it forms a single cube, 67 feet on each side. You could walk around it in minutes. And after you did, it would produce nothing. It would pay no dividend. It would generate zero operating profit. It would simply sit there, waiting for the next buyer to believe it was worth more than you paid. That is not an investment. That is a bet on collective psychology. Keynes called it the beauty contest. You are not picking the most valuable asset. You are guessing which asset other people will find most attractive. The moment the crowd changes its mind, your safe haven reprices without mercy. What about owning a business? Surely a profitable company beats inflation, and in many cases it does. Imagine you invest $1,000 in a business that earns a 10% profit, $100. That feels like a win. But then inflation runs at 10%. Your next round of inventory, raw materials, or equipment now costs $1,100. Your entire profit has been consumed by the rising cost of simply staying in business. You ran hard. You stayed in place.
Buffett identified this pattern decades ago. He called it the capital-hungry business trap. Companies that require constant reinvestment just to maintain their current output are not building wealth during inflation. They are treading water while the current pulls against them. So, cash loses. Bonds lose. Gold produces nothing. And even profitable businesses can be eaten alive by rising replacement costs. If every traditional store of value has a fatal flaw, what exactly is left? An asset is anything that generates future cash flow. By that definition, your ability to earn, your professional skill, is the most powerful asset on the balance sheet. And it has properties that no gold bar, no bond, and no savings account can match.
Skills cannot be taxed at the formation stage. The government cannot assess a levy on the knowledge you build inside your own mind. Skills cannot be confiscated. No market crash, no currency devaluation, no political shock can reach inside your competence and subtract from it. There is, however, one force that can destroy this asset. It does not come from outside. It comes from inside, from the daily choices you make about where your hours go. And the data on those choices is not flattering. The average person loses 2 hours and 31 minutes to social media scrolling each day. In the United States, total daily screen time reaches 6 hours and 40 minutes. Inside the average office, the productivity loss from digital distraction runs to 1 hour and 15 minutes per worker per day. Added up globally, economists have calculated the total annual cost of this lost output: $438 billion. Not lost to a recession. Lost to a scroll. Now, make it personal. 2.5 hours a day is not a small number. Over 5 years, that is more than 4,500 hours. 4,500 hours redirected into a technical skill, a language, or a discipline that the market prices, and the math of human capital changes permanently. This is what Buffett means when he talks about opportunity cost. Every hour has exactly one owner. You decide where it is deployed. Ask yourself what you are choosing when you choose not to invest in yourself. Then ask whether you can afford that choice again tomorrow. The 10% rule makes this concrete. From every dollar of income, a $50 tip, a $100 side job, a full paycheck, 10% goes directly to investment before anything else is spent. You pay yourself first. That money becomes capital that generates its own return, working every hour of every day while you sleep. Apply the same rule to time.
10% of your working hours allocated to deliberate skill development before anything else claims them. Not if time permits, not at the end of the day when willpower is exhausted. First. Morgan Housel, one of the clearest financial thinkers of this generation, makes a point that cuts through all the complexity. Investing is not primarily about knowing complicated formulas. It is about controlling your behavior. The enemy of every investor is not the market. It is the impulse to consume today at the cost of compounding tomorrow. So, if inflation destroys cash, bonds, gold, and even profitable businesses, what exactly does the market actually reward? The answer is hiding in the salary data, and the numbers are brutal. The labor market does not have feelings. It does not reward effort. It does not care about your intentions. It prices one thing and one thing only: the value you can deliver. And it does so with the cold precision of a machine.
Consider the numbers directly. In the IT market, a trainee earns $500 a month. That is the starting price. 27 applicants compete for every single vacancy at that level. Supply vastly exceeds demand. The market is telling you something. Listen to it. Stay on that path for 1 year. Just 1 year of deliberate, accumulated experience. And that number moves. $700 a month. It is not dramatic, but the direction is unmistakable. The curve is beginning to bend. Now, push further. Reach senior level. 5 or more years of compounded skill, and the market responds in a way that looks almost irrational until you understand what is actually being priced. A senior back-end developer commands $4,800 to $6,800 a month. That is not a salary. That is the market's precise valuation of irreplaceable.
And at the absolute frontier, machine learning, artificial intelligence, the senior rate reaches $6,000 to $9,000 a month. Demand for ML and AI expertise has grown 88%. The market is not waiting. It is already paying for the future. The only question is whether you are building toward it. Here is what that curve actually represents. It is not time passing. Time alone buys you nothing. That curve represents the compounding of applied knowledge, skill stacked on skill, each layer making the next layer more valuable. This is compound interest in human form. No central bank can print it. No inflation can erode it. Think about what it costs to acquire that knowledge. A serious online course, a technical book, hours of deliberate practice instead of passive consumption. The capital required is measured in weeks and months of focused effort. The return is measured in thousands of dollars per month.
No conventional asset class offers that ratio. But skill is not only technical. The data on organizational investment in learning makes this clear. Companies that implement formal training programs generate 218% higher revenue per employee. Their profit margins run 24% above their competitors. The return on every dollar invested in employee development is $4.53. The market prices learning at the institutional level with the same ruthlessness it applies to individuals. And the workforce knows it. 94% of employees say they would stay longer at a company that invests in their development. 76% say they would leave if access to learning were removed. People are not loyal to salaries alone. They are loyal to growth. Remove the growth, and you remove the person. What does this tell you about your own calculus?
If you would leave a company that stopped investing in your skills, why would you accept a personal life that does the same? The logic is identical. The stakes are higher. It does not come from a salary database or an economic model. It comes from the office of Warren Buffett, the most studied investor in the history of capitalism. On the wall of that office hangs one certificate. Not his degree from the University of Nebraska. Not his master's credential from Columbia Business School, where he studied under Benjamin Graham, the architect of value investing. One certificate from a Dale Carnegie public speaking course. Buffett paid $100 for that course. He was 20. He built the skill. And when asked about that investment decades later, Buffett stated that it raised his personal capitalization by a minimum of 50%. Not 5%, 50, from a $100 expenditure. That is the return profile of human capital when directed with precision. But that is not the point. The point is the ratio, the mechanism. A targeted investment in a specific high-leverage skill produced a return that no stock, no bond, no real estate position in his portfolio could match on a percentage basis. And here is the detail that sharpens the lesson further. 99% of Buffett's wealth was accumulated after his 60th birthday. He began compounding at age 11. He did not stop. The certificate on his wall is not a trophy. It is evidence of not a fortunate inheritance, not a market that happened to move in the right direction. A system, applied without interruption, across decades. That is the pattern. It has always been the pattern. Most people are looking for the shortcut inside the system. There is no shortcut inside the system. The system is the shortcut. But the system only runs on one fuel, and you are choosing how much of it to burn every single day. The content you consume tonight will not raise your capitalization by 50%. The skill you build tonight might. That is not motivation. That is arithmetic. And the market enforces.
The best investment you will ever make does not require a brokerage account. It requires only one thing: the discipline to choose a book over a scroll every single day.